You know that feeling when your paycheck hits your bank account? It's great, right? But what if I told you that number, well, that's just the tip of the iceberg. Behind the scenes, your employer is keeping a running tab of a whole lot of other promises they've made to you, and how they account for them is a surprisingly fascinating journey.
So let's just ask the big question right up front. At any given moment, what does your employer really owe you? The answer, as you're about to see, goes way beyond just your next paycheck.
See, when you get a job, you're not just getting a salary. You're getting a whole package of promises. And we're talking about all the good stuff. Your vacation days, your sick leave, maybe even long service leave, superannuation, bonuses, the list goes on. Each one of these is a form of compensation for the work you do.
All right, let's start with the basics, the one we all know and love, your salary. But even this isn't as simple as it looks. To an accountant, your salary isn't just a payment they make. Nope, it's an obligation that's building up every single minute you're on the clock. Okay, picture this. Your company's financial year ends on a Thursday, but you don't get paid until Friday. Well, you worked Monday, Tuesday, Wednesday, and Thursday, right? They got 4 days of work out of you. That work wasn't a gift. The company owes you for those 4 days, right now.
And this is where it gets really cool how accountants handle this. Instead of complicated jargon, just think of it as an IOU. By the end of the day on Thursday, the company has a giant IOU out to all its employees for 4 days of work. And they have to put that IOU right there in their financial books. Accountants call it an accrued liability, but IOU works just fine for us. Then, boom, Friday comes, you get paid, and the IOU is torn up. Simple as that.
Okay, so salary makes sense. It's an immediate debt. But what about the promises that aren't due right away? Let's level up the complexity and talk about your paid time off. You know, every single day you work, you're earning a little bit of that sweet vacation time. From the company's point of view, that's not just a perk, it's a debt that's getting bigger and bigger. It's another growing IOU they have with you.
And here's how they make that IOU official. They don't just hope for the best. Accountants actually create something like a virtual savings jar, which they call a provision for annual leave. And they keep adding to it, making sure the amount in that jar always matches the vacation time you've earned. That way, the company's books are always telling the truth about how much they owe their team.
But wait a minute. Is all leave created equal? Annual leave seems pretty cut and dried. But what's the deal with sick days? Do they handle those the same way? Well, it turns out there's a huge difference, and it all comes down to whether your sick leave is vesting or non-vesting. Vesting is the easy one. It means if you don't use it, you get paid for it when you leave. So, yeah, it's a direct IOU, just like your vacation time. But non-vesting leave, that's the classic use it or lose it kind. You can't cash it out. And for accountants, that changes the entire game.
Yeah, for that use it or lose it sick leave, the company doesn't actually owe you for every single day you've banked. Instead, they only have to account for the sick days they think people will actually take. And this is where accountants suddenly become fortune tellers. They have to pull out their crystal ball, look at data from past years, and basically predict the future to figure out how big that IOU needs to be. All right, you with me so far? Salary, annual leave, even tricky sick leave. Now, let's tackle the final boss of employee benefits. Promises that might not get paid out for 10, maybe even 20 years. I'm talking about long service leave.
So in some places, if you stick with one company for a really long time, like say 10 years, you earn this amazing reward, a huge chunk of extra paid time off. It's an awesome perk for you, but for the company's accountant, it's a serious long-term puzzle they have to solve. And that puzzle brings us to a really fundamental question about money. Let's say your long service leave is going to be worth $10,000 when you finally take it in a decade. Does that mean the company should record a $10,000 IOU for you today? What do you think? The answer is absolutely not.
And the reason why is this awesome concept called present value. Think about it. $1,000 in your hand right now is way more valuable than the promise of $1,000 10 years from now, right? You could invest it, earn interest. Plus, inflation makes future money worth less. So, accountants have to take that big future payment and discount it to figure out what it's really worth in today's money.
And figuring out that present value, oh boy, it is not simple. This is where the real number crunching happens. Accountants are looking at all sorts of things. What's your salary likely to be in 10 years? What are the odds you'll even still be at the company to claim the leave? They look at market data like bond rates, and they plug all of this into complex formulas to turn that fuzzy future promise into a hard number on today's financial statements.
Okay, wow.
So we've gone from a simple weekly paycheck all the way to predicting the future and using financial wizardry to discount it back to today. You might be wondering, why on earth did they go through all this hassle? Let's zoom out and look at the big picture. It really all boils down to one thing: honesty. It's about making sure a company's financial reports tell the whole truth. These rules force them to show the full cost of having a workforce, not just the cash they happen to be paying out this month, but the true weight of every single promise they've made to their people. So let's just quickly run through what we've figured out. First, your compensation is way more than just a salary. It's a whole bundle of promises. Second, for every single one of those promises, the company has to create an IOU, a liability on its books. Some of those IOUs, like your salary and vacation time, are for right now. But others, like long service leave, are basically long-term bets on the future, and they have to be valued in today's dollars.
And I'll leave you with this one last thought to ponder. You always hear that phrase, right? Our people are our greatest asset. But after all this, we know that a company's people also represent one of its biggest liabilities. So here's the question: what does the size and the shape of that liability, that mountain of promises, really tell us about a company's true health and its future?